between innovation and regulation, we need to understand
the structure and the evolution of the U.S. banking system itself.
Yeah, absolutely.
So maybe that's a good place to pick up in part 2.
Sounds good.
What do you say? You can take a quick break?
Yeah.
And come back and try to...
Let's take a break.
Yeah, unravel the complexities of the...
We'll come back to that.
U.S. banking system.
Yeah, sounds good.
All right, we'll be right back.
Okay, so the U.S. banking system...
It's a beast, right?
Yeah.
I mean, you've got the Federal Reserve and commercial banks and all these other institutions.
Right.
The PDF does give a decent overview, but I have to admit, it's still hard to kind of wrap my head around.
It's a complex system, for sure.
How it all fits together.
But I think if we start with the basics, we can kind of break it down.
Okay.
So the U.S. has what's called a dual banking system, which means there are banks that are chartered at the federal level and banks that are chartered at the state level.
Okay.
And at the top of the system sits the Federal Reserve,
right,
or the Fed, as it's commonly known, which is the central bank of the United States.
Okay.
And its job is to...
So it's like the conductor of the financial orchestra, right?
Yeah, exactly.
And making sure everything...
oversees the whole system, tries to make sure that it's all stable and functioning properly.
But the U.S. hasn't always had a central bank.
No, it hasn't.
Right. The source material mentions that there were periods when we didn't.
Right.
What happened during those times?
Yeah, so from 1837 to 1914, the U.S. actually operated without a central bank.
Wow.
And it was an era marked by frequent financial panics and bank runs.
So imagine, like...
You can imagine the chaos.
Everyone rushing to the bank to get their money out?
Exactly.
Yeah.
Because they're afraid the bank's going to collapse.
Sounds like a recipe for disaster.
It was very volatile and unstable time.
So the creation of the Fed in 1913.
Yeah, so in 1913, the Federal
Well,
Reserve
let's just be a response to that.
was created.
Okay.
Precisely to try and address these...
To try to bring some...
issues of instability.
Stability to the system. Okay. And the source material also talks about this trend of banking industry consolidation.
Yes.
You know, where you have these fewer and fewer, but larger banks.
So you have these large, complex banking organizations.
Is that a good thing? Is that a bad thing?
That's a really good question.
Yeah.
It's a complex issue.
Yeah.
On the one hand,
yeah.
consolidation can lead to greater efficiency.
Okay.
And economies of scale.
Right.
You know, a bigger bank can.
Right. So they can offer maybe a wider range of services.
For a wider range of services,
Yeah.
potentially lower costs for customers.
Okay.
But on the other hand, it raises concerns about competition
Right.
and also about systemic risk.
Systemic risk. What does that mean?
So systemic risk is basically the risk that
Okay.
the failure of one
Yeah.
very large financial institution
Great.
could
Yes.
trigger
Right.
a cascade of failures.
Oh. Okay, like a domino effect almost.
Exactly, a domino effect
Yeah.
throughout the entire system.
Right, so like Lehman Brothers in 2008.
Exactly, like Lehman Brothers, you know, when they
And that almost brought down
collapsed, it had ripple effects throughout the whole
global economy.
global economy.
So too much concentration in the banking industry
Exactly.
could make us more vulnerable
It could make the system more fragile.
to these kinds
We're
of
more prone to these
meltdowns.
types of systemic events.
Yeah, that's a scary thought.
It is something that policymakers are
Yeah.
very aware of.
Okay.
And are constantly trying to.
And how do they try to manage that? I mean,
Yeah, it's a tough one.
the source material mentions things like screening and monitoring and restrictive covenants.
Yeah. So these are
Can you explain what those are?
all tools that
Yeah.
banks and other financial institutions use
Okay.
to manage risk.
Yeah.
So screening is basically carefully evaluating potential borrowers, you know, looking at their credit history, their income, their assets,
Yeah, right.
to try and assess their creditworthiness.
It's trying to weed out.
Exactly.
Yeah.
The risky borrowers.
The risky borrower.
Monitoring is what happens
Right.
after the loan has been made.
Oh,
So it's
okay.
basically keeping tabs on the borrower,
Yeah.
making sure they're
Making sure they're not
making their payments.
doing anything shady.
Checking for any signs of trouble.
Okay.
And then restrictive covenants are basically rules that are built into the loan agreement to limit the borrower's actions.
So putting some constraints on their behavior.
Yeah, basically trying to protect the lender's interest.
So it's kind of a multi-layered approach to managing risk, right?
Multi-pronged approach.
From selecting borrowers carefully.
Yeah, to make sure that
to keeping an eye on them.
The money is used responsibly.
Yeah.
And that the system as a whole.
Yeah, some constraints on
remain stable.
Their behavior. Right. And I guess this all comes back to the role of the Fed, right?
Yeah, the Fed plays a crucial role in all of this.
And the PDF kind of breaks down its structure.
Yeah.
With the Board of Governors.
So you have the Board of Governors.
And the 12 regional Federal Reserve Banks.
12 regional Federal Reserve Banks.
Then the FOMC.
And then the FOMC.
Can you unpack that structure for me?
Yeah. So imagine it as kind of a pyramid.
Okay.
At the top, you have the Board of Governors, which is based in Washington, D.C., and they're responsible for setting the overall direction for monetary policy. Then you have the 12 regional banks.
Right.
Each of them is responsible for a specific geographic area of the United States.
So those regional banks are kind of like...
They're like the Fed's boots on the ground. Yeah. They implement policy, they collect data, they provide banking services to their member banks.
So keeping a pulse on what's happening in their particular region. Okay. And then there's the FOMC.
And then there's the FOMC.
The Federal Open Market Committee.
Which stands for the Federal Open Market Committee.
Right.
This is kind of like the most powerful body within the Fed.
Okay.
It's made up of the Board of Governors.
Okay.
And a rotating group of regional bank presidents.
Right.
And they meet regularly to decide on key monetary policy actions.
So these are the folks who are really... setting interest rates.
They set interest rates. Yeah. They decide...
That's a lot of power.
...on whether to buy or sell bonds.
Yeah, a lot of power concentrated in that.
All these things that affect the money supply.
Right. Small group of people.
Yeah.
And the PDF talks about how important it is that...
Yes, it does.
The central bank, it's independent.
The source really emphasizes...
Yeah, why is that so crucial?
The importance of central bank independence.
Yeah.
So it's important because it helps to prevent... short-sighted political interference in monetary policy decisions.
Right, so you don't want politicians.
You don't want politicians who are focused on winning the next election.
Right, manipulating interest rates to make the economy look better.
They might be tempted to lower interest rates to try and boost the economy.
Right before an election.
Yeah, right before an election, even if it might cause problems down the road.
Yeah, the best thing in the long run.
Yeah, so central bank independence basically allows policymakers to focus on the long-term health of the economy, even if it means making decisions that are unpopular in the short term.
Right, so it's like giving them the freedom
to
make tough decisions.
It's giving them the space to make the right decisions.
Yeah, even if they're
not
politically expedient.
Right, okay. And the source also points out this really interesting finding that the more independent a central bank is, the lower the inflation rate tends to be.
Yeah, that's a really interesting correlation.
Which makes sense, right?
It does make sense.
If politicians are in charge?
Because politicians might be tempted to...
They might be tempted to...
inflate the economy.
Yeah, juice things up.
For a quick boost.
Right.
But that can lead to...
Yeah, even if it...
long-term pain causes problems down the road. Okay. So what are the tools that the Fed uses to actually manage the economy?
So the Fed has...
I mean, I know they can set
interest rates, but how do they do that?
So the primary tool they use is something called open market operations.
Okay, I've heard that term, but I don't really.
Yeah, so this is basically where the Fed buys or sells U.S. Treasury securities in the open market.
Okay.
And they do this...
So it's like they're playing this giant game of financial...
a tug of war.
Like a tug of war.
Right. Pulling money out of the system.
They can either inject money...
or putting money into the
system. Or pull money out.
Okay.
So when they buy bonds... they're putting more money into the hands of banks, which in theory should make banks more willing to lend, which should lower interest rates and stimulate economic activity. Because they sell bonds. They're taking money out of circulation, which tends to raise interest rates.
Right, so it's like they're...
and cool down the economy.
Yeah, tightening or loosening the money supply.
Exactly.
Right.
It's like a tap.
Okay. But I imagine it's not.
that they can turn on or off.
Always easy to predict how those actions are going to
No.
ripple through the economy.
And it's not a perfect science.
Right.
It's very difficult to predict exactly how these things are going to play out.
Okay. PDS even mentions.
And in fact,
Yeah.
the Fed has made some pretty big blunders in the past.
Okay.
Like, like during the Great Depression.
Yeah.
And the great inflation of the 1970s.
Yeah, those were not
their finest moments.
their finest moments.
Yeah.
What went wrong there?
So during the Great Depression, they actually tightened monetary policy at a time when the economy needed
Right. So it's like they
more liquidity.
Yeah, they made things worse.
Which some argue actually exacerbated the crisis. And then during the 1970s, they really struggled to control inflation, partly because they misjudged the relationship between the money supply and prices.
Yeah, even the experts can get it wrong.
Yeah, even the best economists can make mistakes.
It's a reminder that managing an economy...
It's a complex system.
Yeah,
it's more an art than a science.
It's not an exact science.
Yeah.
There's no simple formula for success.
Right. You have to constantly be kind of reacting to the...
Adapting and adjusting.
Changing conditions to new information.
Okay. Well, and I know the Fed has this dual mandate, right?
Yes, they do.
Promoting
maximum
employment and price stability.
Maximum employment.
That sounds like a tough accountability act.
It is a very difficult balancing act.
Because sometimes those two goals...
Because sometimes those goals are in conflict.
In conflict, right.
Yeah, exactly.
Like if you're trying to get inflation down...
So if the economy's overheating and inflation is rising...
Yeah, have to raise interest rates, but then that could...
The Fed might have to raise interest rates to cool things down.
Yeah.
But that could lead to...
lower job growth.
Constantly weighing.
It's a constant trade-off.
Yeah. And these trade-offs. Okay. Well, we've talked about the domestic banking system, the role of the Fed.
Yeah.
But what about the global financial system?
Right.
How do currencies move around the world?
So this is where we get into...
What determines their value? That's where I start to feel...
The world of exchange rates.
Yeah, really lost.
Which can be very confusing.
Yeah.
But it's essentially the price of...
one currency in terms of another. So, for example, how many U.S. dollars does it take to buy 1 euro?
Right.
And these exchange rates can fluctuate constantly.
Yeah. Okay.
And those fluctuations can have big implications for businesses, for consumers, or investors.
So, like, if the dollar weakens against the euro, that means it's more expensive.
Exactly. For Americans to travel to Europe.
But cheaper for Europeans.
But it's cheaper for Europeans to come to the U.S.
Yeah. Okay.
Right? And it can also affect... businesses that import or export goods, investors who have holdings in foreign markets.
Okay. So what are some of the factors that actually drive...
So the source breaks it down into kind of long-run factors and short-run factors.
Okay.
The long-run factors include things like relative price levels, productivity differences between countries, and trade barriers.
Okay.
So, for example, if a country consistently has higher inflation than its trading partners, its currency is likely to depreciate over time.
So it's like a balancing act almost, right?
Yeah, exactly.
Okay.
Exchange rates tend to adjust to reflect these underlying economic realities.
Yeah.
But then in the short run, things can get a bit more volatile.
Yeah, what kind of things?
So you can have things like investor expectations, changes in interest rates, even speculation.
Right. So if people believe that a country's economy...
Exactly. If investors believe that a country's economy is weakening, they might start selling off its currency, which can lead to a depreciation.
Okay. So
it's a mix.
Yeah, a mix of fundamentals.
Yeah, those fundamental economic factors. Those kind of psychological factors.
They're very similar to the stock market.
Okay. And I know the PDF mentions something called the interest parity condition.
Yeah. So this is
what's that all about?
A key concept that helps to explain the relationship between interest rates and exchange rates. Okay. Essentially.
Yeah.
What it says is that investors should expect to earn similar returns on comparable assets, regardless of the currency.
Okay.
So if there's a difference in interest rates between two countries, the exchange rate should adjust to offset.
So if interest rates in the U.S. go up.
Yeah, so if interest rates in the U.S. rise relative to, say, Europe, we might expect the dollar to appreciate against the euro because investors are going to want those higher returns.
Exactly, because investors are seeking those higher returns.
But again, I imagine it's not always.
But of course, it's not always that simple in practice.
Right.
There are many other factors that can influence exchange rates.
Right.
So it can be a very complex.
A complex market to...
An unpredictable market.
Predict. Okay. The source material also touches on these international monetary regimes.
So things like...
Yeah, like the gold standard.
The gold standard and...
The Bretton Woods system.
The Bretton Woods system.
What were those all about?
Right. So these were...
And why did they collapse?
Essentially attempts to create more stability in the international monetary system by fixing...
So instead of currencies floating freely.
Exactly.
Yeah.
So under the gold standard, countries fixed their currencies to gold.
A certain amount of gold.
Right. Okay. And under the Bretton Woods system... they fix their currencies to the U.S. dollar.
Oh, okay. So the U.S. dollar was kind of like the...
Which was itself...
Yeah, the anchor currency.
Pegged to gold.
Okay.
So it created a degree...
Presumably provided some stability, but then...
Predictability and stability. But it also came with some drawbacks.
Okay.
One of the main drawbacks was that it limited a country's ability to use... monetary policy to manage its own economy.
Okay.
So if a country's economy was weakening, it might need to devalue its currency.
Right, to make its
exports more competitive. But it couldn't do that under a fixed exchange rate.
Right, because it was
system.
Yeah, locked into this.
It was this trade-off between
stability and
flexibility, and ultimately both of these systems collapsed because they couldn't really accommodate
because the world was changing, right?
The evolving needs of the global economy. So they weren't.
So it's a reminder that even
flexible enough to survive.
These seemingly robust systems can be vulnerable.
Change and disruption.
Shocks and changes.
Right. Okay. Well, this conversation has really, I think, illuminated a lot of the complexities of this global financial system, from exchange rates and currency regimes to
very complex and interconnected system.
The role of central banks. But I'm curious, like, how do we even measure the health of an economy?
It's a great question. What determines its...
And that brings us to overall output.
The concept of aggregate demand.
Okay.
Which is basically the total spending in an economy.
All right.
So it's made up of four main components.
Okay.
Consumer expenditure.
Okay.
Investment spending.
Okay.
Government spending. And net exports.
Okay.
Which is the difference.
So exports and imports.
Right. It's like we're trying to understand how an economy is performing by looking at how much...
So we're looking at all the spending.
Money is being spent.
By consumers.
By consumers.
By businesses.
By businesses.
By the government.
And then, on goods and services.
By foreigners.
On our business services.
Other countries.
And the interaction of all these spending components determines the overall level of
economic activity.
Hinging with these four cylinders, firing to drive output.
It's like a giant engine.
And if one of those cylinders starts to sputter,
with all these different parts working together,
the whole engine might struggle.
Yeah. And if one part breaks down, the whole engine can stall.
Well, that's a good analogy.
Yeah.
And to visualize this, economists use...
So economists use this tool called the Keynesian cross diagram.
Oh, okay, a diagram. Now you're talking my language. What?
So it's a simple graph that plots aggregate demand on the vertical axis and aggregate output on the horizontal axis.
Okay.
And it basically helps us to see how changes in those spending components can shift the aggregate demand curve and therefore impact.
So like if consumers suddenly got a boost of confidence.
Right. So if consumers suddenly become more confident and start spending more, that would shift.
Aggregate demand curve upwards.
The aggregate demand curve would shift to the right.
Right.
And that would lead to higher output and economic growth.
Right. And there's this interesting concept that the PDF talks about called the expenditure multiplier.
Yes, the expenditure multiplier.
Which I always found fascinating. It's this idea that...
Yeah, so what that basically says is that
an initial change in spending.
An initial change in spending.
They'd have these
ripple effects.
Have a ripple effect
Throughout the economy. Leading to a much larger overall impact.
On output.
Right. Okay. So it's like
so you can think about it like
throwing a pebble into a pond.
Throwing a pebble into a pond.
Yeah.
And you get these ripples.
And those ripples just keep spreading outward. That spread outward.
Yeah.
And so one person's spending becomes another person's income, which then fuels more spending.
Right. And so on and so forth.
And so on and so forth.
Okay.
And this is why.
Exactly. And this is why.
Governments often use fiscal policy.
Governments often use fiscal policy to try and
stabilize the economy.
Manage the economy.
Right. So for example, during a recession,
the government might increase.
They might increase spending on infrastructure projects or something.
Infrastructure projects, or cut taxes,
right? To try to boost, aggregate demand, get people spending again,
and get the economy moving again.
Right. Okay. But we've also talked about monetary policy.
Right. So monetary,
those actions taken by the Federal Reserve.
Policy is those actions taken by a central bank.
How does that fit into this picture? So monetary policy works primarily through interest rates.
Okay.
As we discussed earlier, the central bank can influence interest rates.
Right. Through those open market operations. Buying or selling bonds.
To increase or decrease.
Right. So it's like they're
money supply.
Tightening or loosening the money supply to try to influence interest rates
that they can turn on or off.
Right. Okay. But how do changes in interest rates actually impact spending and output in the real economy?
Changes in interest rates actually filter through to the real economy.
Yeah.
So there are a few key transmission mechanisms.
Okay.
One is that lower interest rates make it cheaper for businesses to borrow money for investment projects.
Right, so that can stimulate economic activity.
Lower rates can also boost consumer spending by making it more attractive to take out loans for things like cars and houses.
Right, okay, so it's not just the direct impact of interest rates on borrowing costs.
The direct effect.
Yeah.
It's how those changes...
It's how those...
ripple through.
Yeah, ripple effects work their way through...
It's the economy.
The economy.
Yeah.
Right, okay. But monetary policy, as we've discussed, it's not perfect.
No, it's not a perfect tool.
Yeah, lags involved.
It's not an exact science.
There's always the potential for unintended consequences.
There are lags.
It's like you said, steering a giant ship.
There are unintended consequences.
You can't just...
It's like steering a giant ship.
Make a sharp turn and expect it to respond immediately.
Yeah, exactly. Very, very careful.
So it requires a lot of...
anticipate how things are going to play out.
Judgment and kind of...
It's a very complex system to manage.
Okay. Well, this conversation has really, I think, highlighted...
It has.
Yeah. The complexities of managing an economy.
It's a constant balancing act.
It is a constant balancing act,
Trying to.
Right, okay. And the PDF touches on...
maintain stability while also fostering growth.
This debate between monetarists.
Right. So the monetarists are those who...
emphasize the role of the money supply.
And the Keynesians
who...
And then you have the Keynesians. Who...
advocate for a more active role for... government intervention.
Government spending is more important.
It seems like there's no...
And, there's no clear consensus.
Clear consensus on which approach is best.
Right. It really depends.
And I guess it probably depends on...
on the specific circumstances.
A lot of different factors.
Yeah. And the political climate.
Right.
The prevailing economic ideology.
It's a dynamic...
It's a very dynamic field.
And constantly evolving field.
Yeah.
Well, this has been, I think, a really eye-opening deep dive for me.
It has.
I feel like I've gotten a much better understanding of how this complex system works.
It's a lot to take in.
But I also realize you've got a better...
There's still so much more to learn.
Sense. Yeah. How it all fits together.
Right. It's like we've just scratched the surface.
Yeah, absolutely.
But it's given me a good...
And that's the beauty of economics.
Foundation to build upon.
The more you learn...
To thank you for that.
The more you realize how much you don't know.
That's the beauty of learning, right?
Yeah. The more you learn, the more you realize you don't know.
Exactly.
Well, thank you for guiding us through this.
It's been a pleasure.
Fascinating worlds. I really appreciate it.
Yeah, no problem at all.
And to all of our listeners out there,
keep learning.
Thanks for joining us on this deep dive.
Stay curious.
Keep exploring, keep learning.
And stay engaged.
And we'll see you next time.
Yeah, see you next time.